Have you ever found yourself wondering what truly allows a business to thrive, to not just survive, but actually grow, even when it's faced with, powerful headwinds and major industry shifts?
Mm,
Or perhaps you've looked at a company and seen impressive revenue growth year after year, yet somehow their profits seem to be squeezed, their margins are going down.
right, that disconnect.
Exactly. It's a fascinating tension, isn't it? A core paradox many businesses grapple with, and it's precisely what we're digging into today.
Yeah.
We're taking a really close look at Auto Partner SA, listed on the Warsaw Stock Exchange, ticker APR.WAR.
Mhm.
They're a major player, increasingly influential actually, in the independent automotive spare parts distribution scene, mainly across Central Europe, but well beyond too.
That's absolutely right. And our mission for you today is really to sift through quite a stack of information investment analyses, detailed company reports, broader market insights, and pull out the most important stuff, the key takeaways.
Right.
We want to go beyond just, listing facts.
Mm-hmm.
We aim to understand the why behind the numbers,
Sure.
to grasp the core opportunities that are propelling Auto Partner forward, but also to clearly identify the big challenges they face. Because this sector is evolving fast.
Super fast.
Yeah. So think of this as your shortcut, your way to get genuinely well-informed about this dynamic and, frankly, often overlooked corner of the European economy.
Definitely overlooked.
We're aiming for a conversation that's, data-driven, sure, but also really accessible. Hopefully interesting, too.
Okay, so let's kick things off with the big picture, the kind of executive overview, because that central tension you mentioned, it's absolutely compelling right from the start.
It really is.
What we're seeing with Auto Partner is this remarkable, pretty consistent double-digit revenue growth. I mean, look at the numbers. In 2023, they grew by an impressive 28.9%.
Wow, yeah.
And then another 12.6% in 2024, hitting a total revenue of PLN 4.11 billion. That's just incredible top-line momentum. Clearly, they're grabbing market share, expanding their reach.
No doubt about the growth.
But, and here's the paradox, the bit that makes it so intriguing.
Hmm.
Their profitability margins are going the other way. They're declining at the same time.
Mm-hmm.
Their EBITDA margin, for example, dropped from a pretty healthy 11.1% back in 2022 down to 8.4% in 2024.
That's quite a drop.
It is. And their net profit margin followed a similar path, going from 7.3% down to 5.1% over those same 2 years. So for you, what does that divergence tell us right off the bat? Why is that such a crucial starting point for understanding Auto Partner?
Well, it's crucial because it immediately flags this dynamic tension. It's not just about the money coming in the door, the sales figures. It's about how much they actually keep as profit.
Right.
And what it costs them to generate that revenue.
Mm.
So a declining profit margin, even when revenue is surging like that, tells us a lot. It could signal intense competition forcing prices down.
Yep.
Or maybe significant cost inflation eating into their efficiency, maybe wages, energy, that sort of thing.
Mm-hmm.
Or it could even be a deliberate strategic choice, prioritizing grabbing market share now, even if it means lower profits in the short term.
Ah, okay. So sacrifice margin for growth.
Potentially.
Right.
For investors, this isn't just a number tweak. It signals a strategic choice, or perhaps being forced into one. Massive growth, but maybe at the expense of current profitability.
Yeah.
The key insight we need to figure out is whether this is temporary, a cyclical thing, or if these lower margins are actually the new reality in this market. That's the big question for their financial health, their long-term sustainability.
Makes sense.
It basically means they have to fight harder to turn sales into actual earnings. And that impacts their ability to reinvest and grow without taking on more debt.
Got it. Okay, that sets the stage perfectly. So let's unpack their core business model then. Auto Partner calls itself a key importer and distributor of spare parts. They focus mainly on passenger cars, light commercial vehicles, and motorcycles too. And they really emphasize their operational approach as a sales and logistics platform specifically designed for just-in-time or JIT delivery. That sounds pretty critical in a fast-moving industry like this, doesn't it? What does JIT really mean for their customers on the ground?
Oh, it's not just critical. It's fundamental. It's the core of their value proposition. Their role as this intermediary is absolutely central to the whole independent automotive aftermarket, the IAM ecosystem.
Oh, IAM, right.
They bridge the gap between over 350 global parts manufacturers, big names, household names, and this really fragmented network of professional repair shops and smaller independent retailers.
Thousands of them, probably.
Exactly. Think about it from the perspective of a small local garage, Speedy Auto Fix down the road. Their most valuable asset is their workshop space, the bays where they fix cars.
Sure.
They just can't afford to stock every single part for every possible car model, every make, every year that might roll in. The inventory cost would be astronomical, the space needed huge, the risk of parts becoming obsolete, massive.
Yeah, impossible.
So Auto Partner's value proposition is this. A customer brings in a car, Speedy Auto Fix figures out what's wrong. They place an order with Auto Partner, and they know that within hours, sometimes even multiple times a day, that specific part will arrive.
Wow, multiple times a day.
Yeah, high-frequency delivery is key. This lets Speedy Auto Fix keep almost no inventory themselves, keep their repair bays busy, avoid costly downtime waiting for parts, and just respond really quickly to customer needs.
So it directly boosts the garage's own profitability.
Absolutely. Speed and reliability are everything. Every hour a car sits waiting for a part, the mechanic is losing money. Auto Partner effectively becomes the virtual warehouse for thousands of these small businesses.
That really paints a clear picture.
Yeah.
And they're not just in Poland anymore, are they? I mean, Auto Partner has made a really strategic, pretty aggressive shift geographically.
They have.
Started in Poland, obviously, but now they operate in over 30 foreign markets. And this shift really hit a milestone in 2022 when their export sales actually reached parity with domestic sales, 50-50.
That's huge.
Yeah, and they've managed to keep that 50-50 split going through 2023 and 2024 as well. Quite something.
It is. And that 50-50 split isn't just a number. It's a really profound strategic transformation. On the one hand, it's a massive positive. It fundamentally reduces their reliance on just the Polish economy.
Spreads the risk.
Exactly. Diversifying across 30-plus European markets gives them a buffer. If Poland hits a downturn or competition gets even fiercer there, those international sales provide resilience. It opens up potentially larger, maybe more lucrative markets in Western Europe, too.
But there must be downsides, complexities.
Oh, absolutely. This is where the complexity kicks in. It introduces new operational and financial exposures. Managing sales in all those different currencies, especially the euro, brings in currency fluctuation risk. That can hit reported profits.
Ah, the FX risk.
Yep. And just inherently managing logistics across 30 countries is way more complex than just operating domestically. You're talking international customs, taxes, legal compliance. It demands a really sophisticated international setup.
So it's a trade-off. Less single market risk, but more operational complexity.
Precisely. It requires a truly robust international logistics backbone to make it work efficiently.
Speaking of logistics, their network sounds like a serious competitive advantage, doesn't it? A real moat. They have these 3 main logistics centers in Poland, Biru, Prusko, Mysłowice, plus a key hub in Poznan, then 2 warehouses in the Czech Republic and over 110 local branches. By the end of 2023, their total warehouse space was over 160,000 square meters. That's a lot of space.
It is a massive footprint, and it's much more than just square footage. The strategic importance of this network, and especially their future plans, goes even further. They're pumping serious money into a new, highly automated 30,000 square meter distribution center in Zgorzelec.
Zgorzelec, where's that?
Right near the Polish-German border. Super strategic location. Planned for late 2025 or early 2026. This is a multi-million-euro project. Think of it as both offensive and defensive. Offensively, it gives them the capacity and, crucially, the speed to really push growth into Western Europe. Germany, for instance. Cut delivery times, boost competitiveness.
Makes sense. And defensively.
Defensively, the sheer scale of the investment, the automation, the robotics, the AI systems, it massively raises the barriers to entry for competitors.
Right. Harder for someone else to copy.
Exactly. You can't just build this overnight. It takes years, huge capital, deep operational know-how.
Right.
It's not just shells. It's complex, automated picking, real-time tracking, optimized routing. It really cements their advantage.
Okay, so that's a huge piece. And finally, on these foundational strengths, let's touch on their product portfolio. They offer this incredible choice, over 250,000 unique SKUs from more than 350 suppliers. Big names like Bosch, Castrol, Continental.
The breadth is key.
But then they also have their own private label, MaxGear. What's the strategic thinking behind MaxGear, especially given those margin pressures we talked about earlier?
MaxGear. It's absolutely critical, especially for profitability. It's a vital lever in a market that's super price-sensitive and competitive.
How so?
They started it back in 2006, and it's grown massively. Now over 35,000 SKUs under the MaxGear brand, making up about 19% to 21% of their total sales.
That's significant.
It is, and here's why it matters for margins. In an environment where margins on the big third-party brands can get squeezed, Max Gear lets them offer a good quality but more cost-effective alternative.
For the price-conscious customer.
Exactly. Often owners of older cars, maybe. And crucially, the profit margins on private label products like Max Gear are substantially higher for Auto Partner than the margins on parts they just distribute for others.
Uh-huh. So it boosts their overall profit mix.
Disproportionately so.
Yeah.
Its contribution to gross profit is likely much higher than its share of revenue, an indispensable tool for defending margins. Plus, they have exclusive rights for other brands too, like Arx Tools and Quaro Brakes, which further differentiates them and often carries better margins as well.
Okay, so we've got a good handle on Auto Partners' core business, their infrastructure, their strategy. But, no company operates in a bubble. So let's zoom out now and look at the wider currents shaping the automotive aftermarket itself. Starting in Poland, what are the big trends?
Right. Context is key.
A huge long-term driver for them has to be Poland's aging vehicle fleet. Beginning of 2025, the average car age there was 15.1 years. That's significantly older than the EU average of about 12.5 years.
Yeah, quite a bit older.
How does that directly translate into demand for aftermarket parts? What does an older fleet mean for a company like Auto Partner?
It's a direct, powerful tailwind. Simple reason. Older cars are generally out of the manufacturer's warranty period.
Right, the first few years.
Yeah. New cars usually get serviced at authorized dealerships using expensive OEM parts. But once that warranty expires, owners look for more cost-effective options. And that's where the independent aftermarket, the IAM, Auto Partners market comes in.
So older cars, even more IAM business.
Exactly. These out-of-warranty cars are overwhelmingly serviced in the IAM. Plus, older cars they break down more often. They need more maintenance, more repairs. Brake pads, filters, suspension parts, maybe even bigger engine stuff, more wear and tear.
Creates a steady demand.
A stable, recurring demand floor. But there's a nuance, a flip side.
Okay.
Owners of older vehicles are often more price sensitive. They want to keep the car running, but maybe without spending a fortune.
Which brings us back to Max Gear.
Precisely. It reinforces the importance of offering those cost-effective options, like their private label brands, catering specifically to that budget-conscious segment.
And the broader European market. Is it growing?
Forecasts generally show modest but steady growth. Low to mid-single digits. It's a mature market overall, but certainly not shrinking. And places like Central and Eastern Europe are often growing a bit faster than the West.
Okay. Now, within that market, we're seeing some interesting consolidation trends, aren't we? Europe seems much more fragmented than the U.S. aftermarket.
That's right. Significantly more fragmented.
In Europe, the top 3 distributors only control maybe 15% of the market. In the U.S., it's closer to 50% for the top 3. What's driving this consolidation in Europe, and what does it mean for Auto Partner?
Yeah, that fragmentation has really kicked off a sustained wave of consolidation. Several drivers. Companies wanting scale to get better prices from suppliers.
Purchasing power.
Exactly. Desire for wider geographic reach, trying to get more efficient through centralized logistics and IT.
Yeah.
You see these huge strategic acquirers like the American giants LKQ Corporation and Genuine Parts Company.
GPC, right.
And powerful private equity firms, too, actively buying up smaller players across Europe to build these big platforms.
So is that a threat or an opportunity for Auto Partner?
It's genuinely both, a dual nature. On one hand, it's a potential threat. These larger, well-funded global players could decide to push harder into Poland and Central Eastern Europe, ramping up competition significantly. Imagine LKQ making a big move there.
Yeah, that would shake things up.
But on the other hand, Auto Partner itself, being publicly listed on the Warsaw Exchange, having a decent balance sheet, they're actually well-positioned to be a consolidator.
They could buy smaller rivals.
They could acquire smaller local competitors who maybe lack the scale or tech to keep up, expand their own share that way. Now, historically, that hasn't really been their focus. They've been all about organic growth.
Right, building, not buying.
But the opportunity is definitely there in a consolidating industry.
Interesting. We also need to think about regulations and how they're changing things, like new EU rules, the end-of-life vehicle regulation, ELVR. It promotes a circular economy, reuse, remanufacturing of parts. How might that affect a distributor focused mainly on new parts?
That's a fascinating one. It could fundamentally shift supply chain dynamics. ELVR wants less waste, more sustainability, right? So incentivize reuse and recycling.
Makes sense.
For distributors like Auto Partner, this could actually open up new business models if they can manage the reverse logistics collecting used parts, often called cores.
Like old alternators, starter motors.
Exactly. Things that can be collected, professionally remanufactured to original specs, and then sold back into the market cheaper than brand new parts.
A new revenue stream.
Potentially. A sophisticated distributor with a big logistics network could become a key player in this circular economy. Offer greener options too. At the same time, you've got tougher emission standards coming, like Euro 7.
Right?
That drives up the technological complexity of cars, which means the replacement parts needed are also more complex, more sophisticated, and often more valuable. Think modern catalytic converters, complex sensors,
More expensive parts to sell.
which plays right into Auto Partner's strength of having a broad, deep portfolio of these high-value components.
Okay, and then there are the really big disruptions, the game changers. E-commerce, obviously.
Yeah.
That's increased price transparency everywhere, upped the competition. Auto Partner seems to have adapted, though. 70% of Polish orders, nearly all international orders, are placed online now.
Yeah, they seem on top of that one.
But then, the elephant in the room, the one everyone in the auto world talks about, the long-term shift to battery electric vehicles, BEVs.
Ah, yes. The big one.
What's the fundamental threat here for a traditional aftermarket distributor? And how should we think about the timeline? Is it imminent?
It is, without doubt, the most significant structural long-term threat. You could even call it existential for some parts of the traditional aftermarket.
Why fundamentally?
Simple reason. BEVs have far fewer moving parts than combustion engine cars and much lower maintenance needs.
Right. No oil changes.
No oil, no spark plugs, no fuel filters, no exhaust systems to replace.
Yeah.
Even brake wear is often less due to regenerative braking,
So fewer parts needed overall.
which will, inevitably over time, shrink the total addressable market for many of the traditional parts Auto Partner sells today. Now, EV adoption in Poland is still early days, only 5% of new registrations in H1 2025. Still low compared to Western Europe.
But growing fast.
But growth rate is rapid. Globally, it's accelerating. This creates a really complex long-tail dynamic for companies like Auto Partner. Meaning they have to manage this profitable but gradually declining legacy combustion engine business for years to come, serving that aging fleet, while at the same time investing heavily in an uncertain EV future.
A future that needs different parts, different skills.
Exactly. Different parts, different diagnostic tools, different technical expertise for the mechanics they supply. It raises a huge question. How agile can a large, established distributor be? Can they adapt their whole product mix, supplier deals, inventory systems, technical training? It's a fundamental challenge needing long-term vision and big capital shifts, balancing today and tomorrow.
So with all these internal strengths and these big external forces swirling around, how does Auto Partner actually stand out? Let's look at market share in Poland again. Intercars SA is the clear leader, right? Around 30% market share.
Dominant, yeah.
Auto Partner is a strong number 2 or 3, around 10%. Interteam is similar, maybe 9–10%. And then below that, it's just loads of smaller regional players, highly fragmented.
Very fragmented below the top tier, that long tail.
So for Auto Partner, does this mean they're mainly trying to slug it out head-to-head with Intercars? Or is their strategy different?
That's a really key point. Their strategy isn't really a direct head-to-head fight with Intercars in Poland. Intercars is just significantly larger market cap, around PLN 8 billion, versus Auto Partner's PLN 2.6 billion.
Big difference.
A direct fight would be incredibly expensive, maybe unsustainable. Instead, Auto Partner seems focused on a dual strategy. First, grab share from all those smaller, fragmented competitors, the long tail. Players who just can't match their scale or efficiency.
Picking off the weaker ones?
Effectively, yeah. They're getting squeezed out or bought up.
Ah.
Second, as we discussed, they're pushing hard on international expansion, going into less saturated markets where they can maybe get a stronger foothold faster.
Okay.
What's interesting is how they carve their niche. Not trying to be biggest everywhere, but maybe the most efficient, reliable, comprehensive in the markets and segments they choose. It's more of a flanking strategy, hitting competitors where they're weaker.
And how exactly do they build that niche? It sounds like their moat, their competitive advantage isn't just one thing, but maybe a synergy of a few core pillars?
Exactly right. It's a combination, interconnected strengths, reinforcing each other, makes them tough to copy. The first pillar is absolutely that logistics network we talked about.
The JIT delivery.
Yeah. We need to reiterate how vital this is. For garages, getting parts multiple times a day isn't just nice to have. It's non-negotiable for their business. Need parts fast to finish jobs, minimize downtime, maximize how many cars they fix.
Keep the money flowing.
Right. Auto Partner's huge network, massive hubs, down to 110 plus local branches, all run by sophisticated IT, provides that speed and reliability. And that network is a massive barrier to entry.
Because of the cost to replicate it.
Immense capital needed, years of operational know-how in routing, inventory, last-mile delivery, plus the complex IT backbone. You can't just rent a few warehouses and compete. It's a complex living system.
Okay, so logistics is pillar one. What's number two?
Pillar 2 is their scale and supplier relationships. Their sheer size gives them huge purchasing power. They're essentially buying for thousands of smaller businesses combined.
Consolidating demand.
Exactly, which means they can negotiate much better terms, discounts, payment conditions with those 350-plus global suppliers.
Better prices, better margins.
Better pricing for customers keeps them competitive. And crucially, higher potential gross margins for themselves compared to smaller rivals. And this advantage gets amplified because they're part of Global Own.
What's Global-O?
It's an international purchasing group, a consortium of aftermarket distributors pooling their buying power globally.
Even more leverage.
Right. Lets them get even better deals with the big international manufacturers. It becomes a virtuous cycle. More scale, better terms, better prices, more customers, more scale.
Got it. And the third pillar?
Pillar 3 is their product breadth and the brand portfolio. Offering over 250,000 unique SKUs makes them a genuine one-stop shop.
Saves garages time shopping around.
Huge time saver. Builds loyalty. They can usually find what they need. And this breadth is powerfully boosted by those exclusive distribution deals they have and, critically, by MaxGear.
Back to the private label again.
Yep. Provides that competitively priced, quality alternative. Crucial for managing margins, especially in tough times.
Yeah.
This mix of breadth and strategic branding lets them serve a really wide range of customer needs and price sensitivities.
Okay, so let me try and summarize this. A new competitor would need not just the products and the supplier deals for 250,000 items, but they'd also need to spend, what, hundreds of millions, maybe more, on the complex physical and IT infrastructure to deliver it all super fast and reliably.
That's it, exactly.
That really does sound like a formidable moat, multi-layered, very hard to attack directly.
Right.
Okay, now let's get into the nitty-gritty. Their financial performance, focusing on 2022 to 2024. Starting with revenue growth, the top-line story, as we said, is pretty darn impressive.
Yeah, the growth is undeniable.
Revenue climbs from PLN $2.83 billion in 2022 up to PLN $3.65 billion in 2023. That's that fantastic 28.9% growth.
Huge jump.
Then another strong 12.6% rise in 2024, taking them to PLN $4.11 billion. And even Q1 2024 kept the momentum going, up 18.9% year over year. Clearly, they know how to grow the top line.
It's certainly impressive growth, and it speaks volumes about their execution and market capture. What makes it even more remarkable, though, is the context.
The headwinds you mentioned.
Exactly. Management has been clear that this growth happened despite ongoing deflationary price pressures from suppliers, meaning they often had to lower their selling prices.
Oh, okay.
And they faced an adverse hit from the strengthening Polish zloty impacting those euro-denominated export sales. Stronger zloty means fewer zloty when you convert euro earnings back.
The double whammy.
Yeah. So if you factor those in, it makes you wonder, how much faster might revenue have grown without those external drags? It's just the underlying operational growth, the share gains, the international expansion is potentially even stronger than the headline numbers show.
Interesting point. But then we get to profitability. And this is where that margin squeeze we flagged right at the start really bites.
Yeah, here's the rub.
While their gross profit dollars went up, which you'd expect with more sales, the margins themselves definitely compressed. Their consolidated gross margin fell from 29.9% in 2022 to 27.1% in 2023, only recovered a tiny bit to 27.4% in 2024.
Losing margin points there.
And the EBITDA margin shows an even steeper drop. 11.1% in 2022, sliding all the way down to 8.4% in 2024.
Ouch.
Consequently, after hitting a record net profit in 2023, their net profit actually fell by 7.0% in 2024, down to PLN 208.0 million.
Stark contrast to the revenue story.
It really is the core issue, the key challenge they're wrestling with. And the drivers are pretty clear from their reports. Their operating expenses, distribution costs, administrative costs, they've simply grown much faster than revenue.
How much faster?
Well, in 2024, for instance, operating expenses jumped 20.1% while revenue grew 12.6%. That's a big gap.
Yeah, costs outpacing sales significantly. Management points mainly to cost inflation, especially the big hikes in Poland's minimum wage, Poland's seen some really aggressive increases lately, and that directly hits the costs for their large workforce, warehouse staff, delivery drivers, admin people.
Labor costs rising fast.
Very fast. It just highlights the challenge of staying efficient when you're growing rapidly and facing external cost pressures you can't easily control. It's this battle between strong top-line expansion and trying to preserve the bottom line.
Which brings us back to Max Gear again.
Exactly.
Yeah.
Those higher-margin private label brands become even more crucial for trying to offset some of that margin erosion.
Okay. And fueling all this rapid growth, it must require a lot of capital, right? Which brings us to working capital and cash flow. Their expansion means they have to tie up a lot of money in working capital. Look at inventory. Grew from PLN 775 million end of 2022 to over PLN 1.1 billion by the end of 2024. That's a huge increase to support higher sales and product breadth.
Absolutely huge. And this big investment in inventory, plus managing receivables for more customers, it directly impacts their cash flow. It leads to what can look like volatile, sometimes even negative, free cash flow. They were negative in 2022 and again in 2024.
Which can look alarming if you don't have the context.
Exactly. It's crucial for you, the listener, to understand this isn't necessarily a sign of distress or bad management. It's a direct reflection of their strategy. Aggressively fund organic growth.
They're choosing to reinvest.
Right. When you're expanding fast, opening branches, entering new countries, broadening the product range, you have to tie up capital in inventory, in goods in transit, in customer receivables. It's a strategic choice.
Okay.
It means in high-growth phases, cash flow can look tight because profits are being plowed straight back into fueling future growth, not paid out or left sitting around.
Got it. Despite these heavy investments and the margin pressure, their balance sheet actually looks pretty solid, doesn't it? They seem quite conservatively managed there. Total debt end of 2024 was PLN 526.6 million against total equity of PLN 1.23 billion.
Yeah, what's fascinating is how this strong balance sheet acts as a crucial cushion, especially when margins are tight and they're spending big on things like Zgorzelec. Their leverage, their debt level, is modest.
How modest?
Their net debt-to-EBITDA ratio has stayed stable in a tight range, around 1.2x to 1.4x over this 2022-24 period.
Which is considered
Very healthy. Typically, below 2.0x is seen as strong, below 3.0x often manageable for growing firms. This disciplined approach gives them huge financial flexibility.
room to maneuver.
Exactly. They could take on more debt for a strategic opportunity if one came up. Or they can absorb shocks without putting the business at risk. It lets them navigate margin pressure and keep investing for the long term, like Zgorzelec, without constantly needing to raise equity or worry about debt payments. Shows a management team balancing growth with prudence.
Okay, so let's talk about those strategic choices in the road ahead. Their capital allocation seems laser-focused on organic growth. That Zgorzelec Logistics Center we mentioned is the big flagship project right now, setting them up for Western Europe. But beyond that specific facility, what are the core pillars of their growth strategy going forward?
Yeah, their strategy is remarkably clear. Organic growth is king.
Mm-hmm.
No flashy M&A, no weird diversifications.
Okay.
It's built on two core, intertwined pillars.
Okay.
First, continuously expand and enhance the existing distribution network. That means new local branches, optimizing current ones, constantly improving logistics, efficiency, new vehicles, better software, more automation. It's about deepening reach and service in existing markets.
Right.
Second, and just as important, accelerate international expansion. Their stated goal is to develop faster than the market through expansion in foreign countries. It's not just about being there, it's about rapidly gaining share in those newer European territories.
Aggressive international push.
Very. And alongside that, they're always working on initiatives to boost profitability from within, pushing proprietary brands like Max Gear for those better margins, and deploying better IT solutions for cost control and efficiency. It's multifaceted, but all aimed at sustaining that top-line growth while fighting the margin headwinds.
It's interesting then that in an industry seeing so much consolidation, LKQ buying things up, Auto Partners' approach seems unique. The sources really point to this intense focus on organic growth. Almost no M&A mention.
It is quite unique, isn't it?
What does this build versus buy approach tell us about their philosophy?
Well, it stands in pretty stark contrast to the wider industry trend. Focusing almost solely on organic growth might seem slower to some observers, but crucially, it avoids the huge financial risks, the massive integration headaches, the potential culture clashes that often come with big acquisitions.
Merging companies is hard.
Notoriously difficult, integrating different IT, supply chains, cultures. It's fraught with potential problems. So what does this say about Auto Partners management, especially being founder-led?
Yeah.
It suggests a strong preference for operational control, a deep belief in their own ability to execute their strategy internally, maybe a desire to keep the company culture cohesive. They're betting on replicating their successful model organically, branch by branch, country by country, rather than dealing with the unpredictability of bolting on external companies.
A more disciplined, maybe steadier path?
Potentially. More controlled, maybe more sustainable long-term, relying on their own strengths.
And that philosophy seems to carry over to their dividend policy, too. Very conservative. PLN 0.15 per share paid for 2022-2023 and recommended again for 2024. That's a really low payout ratio, like 9.5% of earnings. What message does that send investors?
It sends a crystal clear, unambiguous signal. Management firmly believes the best return for shareholders comes from plowing almost all the profits straight back into the business.
Reinvesting for growth.
Exactly. They see more value, higher long-term returns in funding network expansion, pushing international growth, building things like Zgorzelek, than in handing cash back to shareholders right now via bigger dividends.
So the investment case really depends on them getting good returns on that reinvested money.
Absolutely. The whole thesis hinges on their ability to deliver high returns on that reinvested capital over the long haul. It's a classic growth stock approach. Compound value internally, don't distribute it externally, no share buybacks mentioned either, which reinforces that focus. As an investor, you're betting on management skill and generating good returns from that reinvested cash year after year.
Okay. Now, every business faces hurdles. What are the big rocks on Auto Partners' path? The key challenges, the headwinds they've been navigating, especially 2022-24, and what should we be looking out for?
Well, the most immediate challenge, tying right back to that opening paradox, is the macroeconomic pressure, creating that pincer movement on profitability.
Right, costs up, prices maybe not so much.
Exactly. On one side, significant cost inflation, Polish wages, energy costs, that makes operating expenses grow faster than revenue. On the other side, the parts market, especially from suppliers, has seen deflationary price pressures. So their cost of goods might fall, but so does their ability to raise prices to customers.
Squeeze from both sides.
That combination is the main driver of the margin compression. Plus, with half their revenue in euros, they're heavily exposed to FX risk. A stronger zloty, like we saw at times in 2023-24, directly cuts the value of those export sales in PLN terms, hits reported revenue and profit, and that's largely out of their control.
Okay, so macro pressures are big. What about the broader auto industry transition, that EV challenge you mentioned?
That's the fundamental long-term one. The secular shift to EVs is a profound threat to the traditional aftermarket model. BEVs just have drastically different lower maintenance needs, fewer moving parts.
Less stuff to replace.
As the share of EVs grows in the overall car fleet, the total market for many of Auto Partners' core products, oils, filters, plugs, exhausts, engine bits, will inevitably shrink. While it's still early days in Poland, the global growth rate demands a proactive, long-term response.
How do they adapt?
That's the multi-billion-dollar question, isn't it? How do they shift their product mix, retrain staff and customers, build expertise for this new EV world? It needs a totally different inventory strategy, different skills. It's not just a short-term risk, it's a fundamental reshaping of their future market.
And finally, what about supply chain and competitive pressures? Still challenges there.
Always. Managing 250,000 SKUs from 350-plus suppliers is inherently complex. There's always the risk of inventory obsolescence as tech evolves. Stocking the wrong parts means write-downs.
Yeah.
And the market is fiercely competitive. Constant pressure from the leader, Intercars, who has even greater scale. And the consolidation trend means maybe even bigger international players could ramp up focus on CEE, intensifying price wars, and the fight for share. They have to stay sharp.
Let's shift focus a bit now to the people running the show and how the company is structured. Management quality and corporate governance. The leadership team at Auto Partner looks like a real asset, very stable, loads of experience.
He's that way, yeah.
It's founder-led. Mr. Alexander Gorecki started it way back in 1993, still president. Plus, his vice presidents, Andrzej Manowski and Piotr Junta, have been there since 1994 and 2009, respectively. That's serious tenure. What does that long tenure and founder alignment usually mean for a company?
Well, what's really interesting is why that stability and experience are seen as strengths. Gorecki's 3 decades at the helm. That provides consistent, long-term strategic vision. No constant chopping and changing. And as a major shareholder himself, his financial interests are directly aligned with other shareholders. He wants long-term value. The continuity with Manowski and Janta means deep institutional knowledge. They know the operations, the customers, the industry inside out.
That operational expertise must be crucial.
Absolutely essential in a business built on relationships, logistics precision, and deep product knowledge. It suggests a team that really understands their business. Credible.
And on the governance side, how do they handle oversight, accountability? What should listeners know?
Well, being listed on the Warsaw Stock Exchange, they have to follow a formal governance framework, the best practice for WSE-listed companies. That provides important oversight and transparency.
Like a supervisory board.
Exactly. They have a 5-member supervisory board. It oversees the management board, but also formally acts as the audit committee, keeping an eye on financial reporting and internal controls.
Important checks and balances.
Crucially, 2 members of that board are designated as independent. No direct financial ties to management, and they have the required accounting or auditing qualifications. That independent oversight is vital for investor confidence.
Anything else? Compensation.
Yeah, they have formal executive pay policies, including a multi-year incentive scheme. It's designed to link management pay to company performance and long-term shareholder value. That's good practice. Helps ensure management acts in shareholders' best interests. It balances the strong founder leadership with robust independent oversight.
Okay. Now, valuation. How does the market actually see AutoPartner right now? Looking at the metrics, say mid-2025, AutoPartner's trading at a trailing PE ratio of about 12.8x and an EV/EBITDA around 9.8x. How does that stack up against their main rival? What does it tell us?
Right, let's compare. If you look at Intercars, the bigger competitor, their TTM PE is roughly 11.1x and EV/EBITDA around 9.2x.
So AutoPartner is trading at a slight premium.
Yeah, exactly. The market is assigning a valuation premium to AutoPartner. It's not huge, but it's there. Why? Almost certainly due to AutoPartner's historically faster revenue growth and that aggressive international expansion story.
Market's paying for growth potential.
Essentially, yes. We think AutoPartner has better growth prospects, so we'll pay a bit more. But, and this is important, it also means the market has high expectations baked in.
Sets a high bar.
It does. If they stumble on growth, maybe international expansion slows, or, critically, if they don't fix that margin compression, the valuation could start to look stretched. The market's betting on continued strong growth and margins getting better eventually. If that doesn't happen, reevaluation is possible.
And if we were doing our own valuation, maybe a discounted cash flow model like the pros use, what would be the key assumptions driving the result? Where are the big levers?
The DCF. Highly sensitive to assumptions. A few are absolutely critical. First, revenue growth. Can they keep up that double-digit pace, or will it naturally slow down as they get bigger? Performance in export markets, especially Western Europe, is key there.
Okay, growth rate is one.
Second, and this is arguably the most critical lever, profitability margins.
Back to margins again.
Always. A DCF, where EBITDA margins recover from today's 8.4% back towards that 11% they hit in 2022. That gives a much higher valuation than one assuming current lower margins are permanent.
Yeah.
The whole investment case practically pivots on this variable. Can they fix the margins?
Huge uncertainty there.
Massive. Finally, capital intensity. How much money do they need to keep reinvesting to sustain the growth? Assumptions about future capital spending, especially big projects like Zgorzelec and ongoing working capital needs for inventory, those directly hit the free cash flow generated. More spending needed means less free cash flow, lower valuation.
So putting it all together on valuation.
It looks like the market is pricing in continued strong growth and an eventual margin recovery. If you believe the margin squeeze is temporary, cyclical, maybe just inflation pass-through taking time, then today's valuation might seem reasonable.
Yeah.
But if you think those pressures are structural, maybe permanent high competition, sticky cost inflation they can't pass on, then it could look fully valued, maybe even expensive, especially next to Intercars. It's the key judgment call for an investor.
Okay, so as we wrap up our deep dive here, let's crystallize what to watch for. What are the big rocks still on AutoPartner's path? The key risks you'd really want our listener to keep front of mind.
Right, the risk factors. The most significant near-term one, tying right back to our opening paradox, is definitely that ongoing margin compression.
The pincer movement.
Exactly. Rising costs, especially wages in Poland, versus tough pricing competition. If they can't manage costs or pass on prices, it could structurally hurt their profitability, make it harder to fund growth. Then there's currency exposure. Half their revenue is in euros. A stronger zloty hammers reported profits. largely out of their control.
Hmm.
Inventory obsolescence is always a risk with 250,000 SKUs and fast-changing car tech. Stocking the wrong stuff means write-downs. And supplier dependence relying on 350-plus suppliers means a disruption or price hike from a key one could really hurt.
Those sound like the main business and financial risks. What about operational ones, maybe linked to their big plans?
Good point. Yeah. Operationally, there's significant execution risk with big projects like Scorzalek. Delays, cost overruns, tricky ramp-up that could disrupt growth plans, tie up cash badly. And while they haven't done much M&A, if they ever did shift strategy, you'd have the classic integration challenges, merging systems, cultures, often harder and costlier than expected.
And the big picture, industry-level risks. You mentioned EVs again.
Yeah, the EV transition remains the biggest, most fundamental long-term threat. Lower maintenance needs will shrink the market for many traditional parts over time. Their ability to adapt products, skills, training is critical for long-term survival. It's a secular shift, not a blip. And finally, intensified competition. Intercars could use its scale to squeeze margins more, or bigger international players could enter CEE more aggressively. Constant pressure.
Okay, lots to worry about. But where are the upsides? What signals would tell us things are actually moving in the right direction? What are the positive catalysts that could boost AutoPartner?
Definitely upsides, too. The most powerful near-term signal. Clear evidence of margin stabilization and recovery.
Fixing the core problem.
Exactly. Better gross and EBITDA margins in quarterly reports would be a huge positive. Shows they're managing costs and pricing. Second, the successful launch of Scorzalek. On time, on budget, smooth ramp-up, de-risks a big project, unlocks Western European growth, accelerated export growth. Beating expectations in foreign markets would be great news diversification, bigger markets. And finally, favorable currency moves. A weaker zloty against the euro would just provide a natural tailwind to reported results. Free boost.
Okay. And conversely, the red flags, what could go wrong that would signal trouble?
Continued margin erosion is the biggest red flag. If margins don't stabilize or improve, it suggests the problems are structural, not temporary. Could trigger a stock re-rating. The significant economic downturn in Poland or key EU export markets would obviously hurt demand.
Less driving, fewer repairs.
Right? Aggressive competitive actions like sustained price wars from intercars could force AutoPartner to sacrifice even more margin to hold share. That hurts. And finally, any major delays or problems with strategic projects, especially Scorzalek, would be negative. Its capital efficiency delays growth, raises execution questions.
Got it. So for you, our curious listener, what are the practical takeaways? What should you actually keep an eye on if you're tracking AutoPartner or just interested in this industry?
Okay, key metrics to watch beyond the headlines. Monthly sales reports, they give a quick pulse on top-line momentum. The gross margin percentage, absolutely critical. Watch for trends in pricing power or cost pressures. The operating expense ratio, as percent of revenue, tracks their cost control against inflation.
Efficiency check.
Yep. Inventory turnover and day sales of inventory, DSI, tells you how efficiently they're managing that huge pile of stock. Rising DSI could mean slowing sales or overstocking. The huge PLN exchange rate, a key external factor hitting their reported numbers.
Don't forget FX.
Never. And finally, really pay attention to management commentary in their reports and calls. What are they saying about pricing, costs, Scorzalek progress, export performance? Their narrative often signals trends before the numbers fully catch up. #outro Winche.
Wow, what a deep dive into AutoPartner SA. It really is fascinating, isn't it? Seeing a company drive such impressive growth on the one hand, while simultaneously battling these significant margin pressures, rising costs, tough competition, all while the entire industry underneath them is undergoing this fundamental transformation. It's a really delicate, complex balancing act they're performing.
It truly is. And, AutoPartner's long-term success really hinges not just on selling more parts today, but on their ability to profitably bridge these two very different worlds. There's the immense aging fleet of combustion engine cars that still dominate the roads and will need fixing for years.
The legacy business.
Right, that long tail. And then there's the rapidly approaching lower maintenance future of electric vehicles. Can they master the art of managing that legacy business, which is, in effect, a slow-motion decline for many traditional parts, while simultaneously building the completely new expertise, product portfolio, and infrastructure needed for the EV paradigm? That's the ultimate question, the one that will likely define their path for decades.
An excellent thought to leave us with, something for you to ponder as you continue exploring the intricate world of the automotive aftermarket, or maybe dig deeper into some of the financial metrics or business strategies we talked about today. Thank you so much for joining us for this deep dive. We really hope it's provided you with a clear, concise, and maybe even captivating shortcut to being truly well informed.